This is David Russell, Global Head of Market Strategy for TradeStation. And today we'll look at key events for investors and traders. Stocks are falling as traders brace for fewer rate cuts from the Federal Reserve. The S&P 500 slid 0.6% between Friday, December 6th and Friday, December 13th. It was the first negative week in the last four. More than three-quarters of the index's members lost value as interest rate-sensitive companies fell. The Consumer Price Index and Producer Price Index both rose last week, which suggests that inflation has stopped falling. Those numbers set the stage for Wednesday's key Fed meeting. Policymakers are widely expected to lower their overnight lending rate by 25 basis points. The bigger news will be their guidance about future rates and economic forecasts. The information will be in a secondary document that comes out each quarter. It's called the Summary of Economic Projections and includes the closely watched dot plot. Market expectations suggest this week's cut will be the last until March. Bond yields have steadily risen, but are still relatively low compared with shorter-term rates. For example, the 10-year Treasury yield is only about 20 basis points above the 2-year rate. The difference has typically been closer to a full percentage point, which may open the door to higher borrowing costs in 2025. Such a trend could potentially weigh on stock prices and risk appetite. Last week also brought news that the federal government's fiscal deficit rose 17% from November 2023. It was $18 billion bigger than expected. That could also pressure borrowing costs over the long run. Higher rates can potentially weigh on stock prices and risk appetite. That could be especially true for some of the cyclical stocks that jumped after the November 5th re-election of Donald Trump. The Russell 2000 Small Cap Index, banks and industrials all climbed on optimism as administration will stimulate economic growth. Those groups have struggled more recently, using the old adage of buying the rumor and selling the news. Have all the recent gains priced in good news? Is there a risk of traders selling the news as they wait for Trump to take office and announce policies? Some of these cyclical stocks are also sensitive to higher interest rates. Another potential risk could result from weaker growth. For example, initial jobless claims rose more than expected last week. Tomorrow's retail sales report will provide further information about consumer spending. Weaker data could trigger worries about potential stagflation. That's when the economy and employment slow without inflation easing. Broadcom rose the most in the S&P 500 last week and had its biggest gain ever. The semiconductor company jumped after saying it may sell $90 billion of customized AI chips. That surprised investors who were mostly expecting weak numbers. Broadcom also became the 8th American company with a market capitalization above $1 trillion, leapfrogging past Warren Buffett's Berkshire Hathaway. Tesla also zoomed to new record highs as investors focused on potential growth from its Optimus robots. CEO Elon Musk's alliance with Trump has also boosted confidence in the company. That was bolstered by a Reuters report Friday that the incoming administration wants to stop reporting crashes by self-driving vehicles. Some of the S&P 500's other big gainers last week were laggards that bounced on positive news. Wolverine Boots Alliance climbed on a Wall Street Journal report it may be acquired by Sycamore Partners. Warner Brothers Discover announced plans for a new corporate structure to increase profitability. Boeing restarted production of its 737 MAX for the first time in over a month following a labor strike. Alphabet had the sixth biggest gain in the S&P 500 after announcing a new quantum computing superchip named Willow. Consumer discretionaries rose more than 1% last week, and communication stocks were fractionally positive. Aside from those, every major sector fell. Biotechnology, metals, and home builders declined the most. Banks, materials, and small caps also led to the downside. That's consistent with the weakness in cyclicals noted above. Supermicro was the worst performer in the S&P 500 after leading the index in 2 of the previous 3 weeks. Adobe also fell on weak guidance. And now let's chart the market. The S&P 500 swung just 39 points between its high and low last week, its smallest range since the start of October. That may suggest the index has stalled after flirting with 6,100 on Friday, December 6th. In addition, the advanced decline line has fallen every session this month. Friday also saw more index members hitting new 52-week lows than 52-week highs. Those weaker breadth signals may suggest fewer stocks are participating in the rally. Moving average convergence divergence, or MACD, has also been sliding. That could be a sign of weaker momentum. 4 of the 5 candlesticks last week had solid bodies. That means closing prices were below the opening prices, which may suggest that buyers are fading. Chart watchers may see potential support around 6,030, which is near the weekly close on November 29th and the previous week's low. Below that, the mid-November low around 5,855 could be important. We'll now look at events this week, which is the last full week of the year. The Fed meeting is the big item, but there are some other economic events and earnings reports. Nothing important is scheduled for today. Tomorrow brings retail sales, an important measure of consumer activity that's beaten estimates for the last 5 months. Wednesday is the big day. Housing starts and building permits in the pre-market might impact housing stocks. Crude oil inventories are due in the morning. Micron Technology reports earnings in the afternoon. The Fed news begins at 2 o'clock Eastern Time with the policy statement and the summary of economic projections. Chair Jerome Powell delivers a press conference 30 minutes later. Nike and FedEx issue results in the post-market. Friday brings the Personal Consumption Expenditures Price Index, an important inflation gauge in the eyes of the Fed. Thanks for watching. Please visit tradestation.com for more.